Silicon Valley Bank, or SVB, has collapsed, marking the biggest bank failure since the 2008 financial crisis, and the second largest failure in US history in terms of inflation-adjusted assets. So why has Silicon Valley Bank failed, and what is the impact on companies that had deposits in the failed bank, such as Rocket Lab, Roku and Roblox? All of that will be covered in today's video. Firstly, the failure of Silicon Valley Bank was caused by an old-fashioned bank run. The company executives made a few bad decisions which caused depositors to lose faith in the solvency of the company, causing a cycle of withdrawals as fear amongst depositors exponentially increased. This fear seems to have been started by a huge $1.8 billion loss on low-yielding bonds after Jerome Powell and the Federal Reserve cranked up interest rates dramatically over the last few years. Silicon Valley Bank wanted to generate greater returns as it was underperforming relative to some of its banking peers, and Moody's was considering downgrading Silicon Valley Bank's rating. Regardless, SVB still managed to have an investment-grade rating at the time of the collapse. Anyway, this decision alone may not have triggered the collapse of Silicon Valley Bank, and another important decision was made following this. Management, alongside Goldman Sachs, were looking to raise money from venture capitalists and the public in order to calm depositors and public opinion. However, unfortunately, this only served to scare tech companies and their venture capital backers, in which depositors began to run on the bank, withdrawing all of their deposits, which eventually led to Silicon Valley Bank crumbling and being taken under regulatory control on Friday. Anyway, that was a simplified version of the event. And the next logical questions which come to mind are, is there risk of contagion similar to the 2008 financial crisis? And what is the impact on the tech companies like Rocket Lab, Roku and Roblox, who had considerable amounts of cash deposited with Silicon Valley Bank at the time of collapse? So first of all, is there risk of contagion? My answer is that I don't know, and of course there could be. High interest rates have affected every bank, and other banks may also be holding long-term treasuries at a loss. Regardless, the situation is of course not the same as 2008, so let's just see what happens and hope there is not enough fear spreading to trigger solvency issues at other banks and bank runs. So the second point, what's the impact on the depositors? Firstly, the Federal Deposit Insurance Corporation insures $250,000 of deposits per depositor, in which this money will be made available for withdrawal very quickly. Unfortunately, the majority of deposits at the bank were over this $250,000 limit, as is typical with fast-growing startups backed by venture capital and initial public offerings. Many of such companies may even struggle to pay the bills and meet payroll requirements for March 2023. The US Treasury Secretary stated that a bailout is not on the table, potentially due to the issue of moral hazard, in which bailouts send a signal to other banks that they are free to take on as much risk as they want, as they will just be bailed out. One possibility is that another bank buys all or part of Silicon Valley Bank, similarly to the purchasing of Washington Mutual in 2008 by JP Morgan Chase. This is potentially one of the better outcomes, in which depositors likely receive all of their money. Another possibility is the FDIC begins an asset sale if there is no buyer of SVB. So for example, Silicon Valley Bank has tens of billions of dollars of mortgage-backed securities which are highly liquid, and could result in 30 to 50% of uninsured deposits being returned as quickly as Monday, with more to follow later on as other assets are less liquid and also may incur a substantial loss when sold quickly. There may also be potential for Silicon Valley Bank customers to sell their deposit claims to others who speculate these claims are worth more than the selling price in the long run in order to raise short-term cash, e.g. for solvency purposes. Of course, there are many other potential outcomes, but these appear to be many of the most commonly reported ones, according to the articles which I've read. So with that, it seems likely that depositors will get roughly, 40 to 100% of their money back, depending on the outcome in the long run, at least in my opinion. So for Rocket Lab, who had $38 million or 7.9% of their cash invested or deposited into the failed bank, it is reasonable to suggest that they may receive at least half of this back in the long run, resulting in a loss of around 4% of their cash, which is not the main basis for Rocket Lab's $1.86 billion valuation, at least in my opinion. Therefore, this is not financial advice, but I do not think that Rocket Lab's operations will be majorly impacted by the collapse of SVB. Is it a good thing? Of course not. But is it the end of the world? Probably not. But it should be said that Rocket Lab could be in a better position if they diversified slightly more, similarly to other countries such as Roblox, who held 5% of their cash in SVB, or Unity, who held less than 5% of their cash in SVB. However, this can only be said with hindsight, and 7.9% is nothing compared to Roku, who seem to be by far the largest loser at the moment. They had $487 million, or 26% of their cash, locked up in the failed bank, in which they could expect to receive a substantial portion back as previously detailed. Interestingly, Roku is only down just under 10% in the last week's trading compared to Rocket Lab, who is down just under 15%. This is perhaps due to the fact that Rocket Lab is a small firm whose financial position is less established. Anyway, these are just all my opinions based on my reading, and make sure you read my sources down below in the description and leave a comment if you found this video helpful. Thanks for watching.